Hello, my good friends out there. I will greet you as I always do with the official hashtag join, the official hashtag jubilant, smile, and warm hello to all of my good friends out there circling the globe, no matter where you came from. I do want you to know I appreciate you and I thank you for coming by to witness this video today. Therefore, I hope I do my very best so you come back and see. My name is Doug. This is Trade with Doug. And today I want to talk about a question that's on the forefront of all minds out there. And that is this market going to crash? Will you lose everything? Is this the end? And I'm specifically referring to a letter that was circulated around by a Harry S. Dent Jr. Now, I must apologize to all those out there. I don't know who Harry S. Jr. is. I don't even think I said the name right there. Maybe I messed it up. But according to this article, he is the contrarian's contrarian, a professional market demise predictor, one who predicted that this market would crash pre-coronavirus. Now, I'm always skeptical when it comes to letters like this. Now, you must understand that when I started out in '99, it was no different as far as fear-mongering back then as it is today. There were so many people that were talking about market crashes, and they were right because we had some. Now, markets are always going to correct, and crashes are far different than corrections. Corrections are normal things in the market. But I think this fear of doom and gloom, now I've been doing this for 24 years, the market has always rebounded. Every dip buy in history has always worked. But there's always somebody out there, whether it's for news or whether it's for publicity, wants to play the fear-mongering side of the argument. So today I want to talk to you about the history of markets, because I don't care about the contrarian's contrarian. I don't care if somebody got lucky and predicted a market crash and then coronavirus come by. Nobody knew coronavirus was coming by. That doesn't really count, right? I mean, it's not something that was, I want to say it's not economic. I mean, it is to a certain degree, but these are things that are unforeseen. Of course, the market always has to deal with that. But I want to talk to you about real, true market stats from both bullish and bearish, and how the market works, so you can determine whether or not yourself you feel that this market is going to crash. So let's go ahead and talk about a few of these here. And the first thing I want to draw your attention to, give me 1 second because I'm going to open up this chart. And I want you to look at the history of the market itself. So I'm just pulling this up here. This is a long-term stretched out history of the market since its inception, bullish versus bearish. Obviously, the blue at the top is bullish, bottom is bearish. Now, you can obviously see just by your eye, this is why we use charts, guys, is that just by your eyes, there is a pattern here. That the majority of the time, the market is, in fact, bullish, okay? It's always going to be bullish most of the time. Regardless of what we feel, whether things are overvalued, they're too expensive, it doesn't make any sense. The true meaning is we are always going to rally most often than not. So if you're just looking to throw darts on the long side, you're going to be better. Now, why is that? Because the market is rigged to go up. Because you got to understand there's not just your money in there. There's pension money, there's retirement money, there's people's money, there's businesses' money, there's foreign countries' money. The whole world is invested into the United States. You can't have the market going down every day or we're all in trouble, right? So it is engineered to go higher. But I want you to look at this chart because you're going to see something that's constantly repetitive that I want you guys to look and maybe just entertain your mind a little bit. So you look here, you've got some rallies that begin early on in the market. Let me change the color of this. This is going all the way back to the 1930s here, right? So this, you got to also understand, was the infancy of the stock market itself. It wasn't around for that long. So in the infancy, things are misunderstood. Things are less regulated, and we learn from mistakes as we go on. Also, the trading in many of these years back here were more human influence than as they are now over to this side, which is computer algo influenced. And I'll talk about that in just a minute. But you're still seeing a pattern. You've got several up years followed by a crash year here, a couple of years, which is 2 years. If you can't see it, if I'm drawing too much on here, let me get rid of the mess. I don't want to confuse you guys any more than I already have. So you got about a 2-year correction of 60 to 80% here. Now this obviously was the Great Depression. We know a lot about that. We know kind of what happened there. But remember, this was the first real crash in market history. So nobody knew how to handle this. After that, you know, the economy comes back. They rally back from that. And you go on to this 13-year, 800% rally. So the next 13 years is just bullish. Then you get this little blip on the screen of 6 months, a quick, sharp 21% rally, which resets the clock. Follow me. And we go up, you know, I can't even read this. I'm sorry, I'm squinting. But you go up several years here. I think this says 900%, 15 years. I'm sorry, the screen's really little that I'm looking at, and I have to squint. I don't want to, like, do all of this stuff. And then after this decade, 15 years, you have another little tiny blip, just like this one, tiny blip, followed by another rally, blip, rally, blip, long rally, blip, long rally, blip. I think you already see that in the chart, that every little blip to the downside turns into a decade-long rally. The shortest being in here in the 1970s, where you had 6 years and 2 years and so on. But the rest of these average is well over a decade in time. So if you're averaging these all together, every secular bull market after a correction, listen, after a correction, resets the clock, right? And starts this decade-long bullish rally. So if we're just looking at history, and we go back to what we're looking at here without any other influences. You got to remember too, all the way up to much of this right here, there was no Fed influence like there is today in the market. Yes, they always did the interest rates, but they didn't do QE like they're doing it right now. So where I'm going with this is it's natural to see these corrections. Consider it like a wash, rinse, repeat cycle. Everything gets bullish, it starts to expand. It's a natural cycle of any bullish, bearish chart you see or euphoric chart. FOMO sets in, everything gets over-evaluated. Then all of a sudden you get this epic crash, 20, 50, 80% or whatever. Then it resets it and the market goes back to these longer-term rallies. Now think of this. This stops at 2017. So let's say that coronavirus would look like this. You would have another 30% correction here, a little blip in this screen that lasted all of 2 months, right? What if coronavirus, if we were to draw this chart out, now remember it stops at 2017, if we were just to draw the rest of this out, what would it look like? Could we just now, what we're seeing in this market, I know it looks overbought, right? I know it's high, but what if this is just the beginning of another decade-long secular bull market? Now, here's where the confusion comes in for a lot of people. As time goes on, the market itself changes. The way things were done in 99 and 2000 is not how it's done today. There's different elements. So like when we all started trading, it was new. Trading was new to us, and we were all learning for the first time how to trade. We didn't have mentors. Retail traders weren't prevalent like they are today. People didn't even have internet in every location. So when you learned something, you learned a different route and a different method. As time came on and there's more internet, more access to brokerage accounts, processes are quicker, then things change in the marketplace. Different investors bring in different ideas, different traders, and so on. I think what you're seeing now is there's a chart here that I don't have that I'm going to repeat the best of my memory, but something that you can see. These corrections now, since the financial crisis, are getting shorter and shorter in duration. Now, there was a couple of 20% pullbacks that I can specifically remember in recent memory. Once was around 2011. Was a little over 20%, which lasted all of 5 months, okay? So the correction had recovered itself within 5 months. Most of us remember 2018, the Fed raised rates. We had this really aggressive December where the market sold off, went down about 30% and recovered itself by February. Most of us can remember last year, coronavirus losing another 30 to 35% the markets, rallying back immediately a month later. So here's what I am thinking or saying here. I understand how people want to think about a market correction. But I think more than ever now, the market is totally rigged to the upside. I mean, you know the Fed's commitment. Now, whether we agree with this or not is irrelevant at this point because there's nothing that you and I can do to stop this. But if the Fed is going to throw these billions and billions of dollars every single month into the marketplace or to support the market, how in the hell is it going to go down? The only way it's going to go down is if they stop. And everybody knows that. When I say everybody, I'm talking about the upper echelon of investors and traders. They already know this. So you got to understand the climate that has changed from 2008 over to here and the differences. The too big to fail mantra from the banks. Now, every large corporation realizes they can basically get away with murder, right? In the sense, you can lie about your books. You can do bad, underhanded business dealings. I'm not saying that they do. But if you blow up or you screw up, you get a bailout, right? When the airlines went on the cheeser right there from last year, Corona, what happened? Government gave them bailouts. While the rest of the countries are you're just now getting yours. A year later, you're just now getting another stimulus check, right? So the people are down on the bottom, corporations, big government, everybody, that's first. It sucks, but that's the rules, not the rules, but we can't change that right now. We got to deal with the market right here. That's not going to help us right now. We can complain about it, but that's not going to help us make any money. So think about that. The other thing I really think about here too is the times have changed. The access to information and the speed at which information moves is far different than it used to be. So before, like, in the late 90s, early 2000s when I was trading, the market would dump and you wouldn't know. You would not know what happened until sometimes the next day. Or you read it in like the Wall Street Journal newspaper the next day or some publication. You just didn't get access to information. Now with Twitter, you get it in seconds, or when there's some sort of rally, you used to have to pay thousands and thousands of dollars a month for these like Thomas and Reuters feeds to get the instant access to data before anyone else. Now somebody's publishing it on Twitter for free. So it's a completely different environment under different rules, and the speed in which we do things has changed. So what I'm thinking is, look, everything in the future will be twice as fast as the past. You will continue to see what you've seen before. 1 month, 30, 40% haircuts, followed by instantaneous rallies. Everything will happen twice as fast. So maybe that chart I just showed you, we don't go into 10-year secular bull markets. One thing I proposed is maybe coronavirus reset it. But what if we just get one time every year a 25% haircut? Okay, this is the things about. Now, here's what I do want to remind you guys of. None of it matters, okay? Because you still got to trade. You can be waiting on a market crash, and this thing can still go a lot higher. I mean, look at it. Does it need to crash? It absolutely should, but it's not. And this is why we all, who are trading here, are relying on charts. You'll always hear me say this about charts. It's the real true purity of the market, because all known relevant information is reflected right here. So when I am looking at a price right here for 41.59.25, let me get another caller here, highs on the market, you can say, I can say, we all can say, that's overbought. That doesn't mean that's not going to stick. That's a bunch of bullshit. But whatever, we can say it. We can say inflation, or we can say coronavirus, lockdowns, unemployment. Somebody's still buying it. The value is true. The value is whatever somebody wants to pay for it. Just like a Bitcoin. If it wants to keep going higher, it'll keep going. If you can find more buyers, it's going to go higher. That's exactly what's going to happen. So to answer that, I don't know if we're ever going to get a crash, but one thing I do know is that they will all take place the same way. You will always get a warning. So something like this, the old saying is, markets don't crash from all-time high. There's a process that they go through. So when you're looking at a crash, we're talking about 20%, right? So you're going to take almost 8, this is mental math, I might be wrong, and I do apologize if I am. I'm just going to do like round it off. You're looking at 800 plus points that would have to come off of this in order for you to be considered in bear market territory. Now, some will use the 200-day moving average, which is 3,500. Let's say we use that. If you use 20%, then let's say you're all the way down here in the 3,300 areas of a market. That means this thing could sell all the way down here in one single day rapidly, or in a couple of days, and it isn't a bear market. The chart's still bullish because that's just a standard, typical market correction. Look how far you have to go. So in order for this to even be bearish, you've got to trade all the way down here before the market, or the market participants, or how people look at moving averages and such, would even consider this to be a bear market. We're so far away from that. And at this point, it's going to take a substantial amount of time and effort and work to get that done. And what you would need to see is a process that looks very similar to this, where you get your initial pullback, a failed rally, and then another pullback. But this pullback right here will need to make a new low. Then, and only then, could you even consider a market crash? So this is the beauty about what we do. We have ideas. I have ideas all the time, and I'm wrong on a lot of those ideas. But that's why we let the charts do the talking for you technical analysis people out there. It's the market's language to us. It's how it translates things to us. And that's why it's so important, because unless this happens, it's all just gibber babble garbage that doesn't do us any good now. We need to be dealing with stuff that does us good now, stuff that makes us money now, right now. So is there going to be a market crash? Maybe. But it's not some doom and gloom scenario right now where this time is any different. If the market falls, the Fed's probably going to help. If it does want to go lower, we're going to know about it, and we are going to see it. A simple sell-off, a couple of red days, a 10% pullback, just like the NASDAQ went through a couple of weeks ago, is just part of the cycle movement inside of a chart. It goes up and it goes down. And right now, we may have just begun another decade of a rally if we're using that chart. So anyway, guys, I hope this makes some sense, maybe a tiny smidge of a rant. The thing I want you to take away from this in all seriousness is, maybe there's going to be a market crash, but you can't just sit here every day and pray for a market crash. You can't fight a trend this strong and expect to remain solvent. As we all know the saying by now, the market can remain irrational longer than we can remain solvent. If you're a professional trader or aspire to be one, you've got bills to pay. And to me, all that matters is today. I'm trading today. I don't give a damn about tomorrow yet. I'll worry about that tomorrow whenever I get up. I'm not worried. If the market's bullish, I'm with you. If it's bearish, I'll adapt to it. I can go either way. But it does me no good, and us no good, to fight, argue, whine, bitch, and complain about all the politics involved. It's just a waste of energy because we can't change it. Sad, but that's the way it is right now. And we have to go with what we've got to go with, because our bills, our mortgage company, our car payments, they don't care. They don't care if the market's bullish or bearish. You owe them money. So you got to make money. Anyway, guys, I hope this helped you out. As always, if you need my help, feel free to reach out to me. You can find my private training community and all the goodies down in the description box. Feel free to reach out to me if you need help. Thanks for watching this video. Take care. Trade well. Talk to you soon.